East Asian crisis, there's one thing that we need to talk about, and it's this idea that often many countries and banks end up by having two major so-called mismatches. And one is called the currency mismatch, and the other one is called the maturity mismatch. And I think they're very, very simple to understand. So regarding the currency mismatch, it goes like this. There are some countries, including now, of course, the US, Japan, pretty much all the countries that are part of the euro area, and the UK, that when they issue debt, whether it's the government with government bonds or private firms, could be a big retailer in the country, they issue debt in the domestic currency, right? Now, why is it that this matters? Because you issue debt, it's a promise that you will pay a certain amount of money in the future with interest to someone else. But of course, you're only issuing debt because you have some assets, and those assets generate returns. So if you're a retailer, it's with the profits that you make, maybe from that increasing your retailing operations, something that is allowed by increasing the debt. It's those profits that are going to allow you to repay the debt with interest. But the big problem is that often you, as a small open economy, you will not be allowed to borrow in your domestic currency. You have to borrow in a big, an international currency, such as the yen, such as the dollar, such as the euro. And this means that you're going to have this big currency mismatch. Your obligations, your debt, are in dollars, but all your revenue, if you're in Thailand, is in the domestic currency. Yeah? And so the Thai baht. And so if your currency loses value against the dollar, so if the currency is devalued, or if the currency starts depreciating very substantially after you abandon your peg, it means that all the value of that income that you generate in your domestic currency is now going to be worth less in dollars than before. And this is a major problem for many, many countries. It's you borrow in a foreign currency. Every time your currency loses value against that foreign currency, the value of your assets and therefore the potential of your assets to generate income goes down. And so it may well be that before this devaluation, your assets were way higher in terms of value than your debt. But with the devaluation, this could go the opposite way. And so the company goes from being absolutely solvent and fine to being insolvent. And this, when this happens to a bank, the bank goes, of course, bust. Yeah? And with it, many, many companies have relied on that particular bank. So this is so-called the currency mismatch problem. And there is another sort of mismatch, which is a so-called maturity mismatch. And to some extent, lots of banks do this. And just to emphasize that this doesn't need to happen only in developing or emerging market economies, this maturity mismatch has also been one of the major sources of the problems in the financial crisis of 2007 and 2009, and then the euro crisis of 2010 onwards. So this idea that you're basically incurring short-term debt to finance assets that are long-term. Yeah? There are lots of reasons why banks, including banks in developing economies, end up by resorting to use short-term debt. But of course, again, this could be one of the reasons why this is going to be so fragile in the banking system. You're borrowing short-term. So what this means is that you might be rolling over debt of 3 months. So these guys borrow in billions, but they borrow 100 billion, and then 3 months later, they roll over the debt. They say, okay, I'm going to pay you the interest on that amount, the interest for the 3 months, but I'm going to borrow the same amount. And of course, all of this is possible until your creditor says, I'm not renewing your debt. And so the problem now is that you have to repay the debt in full, at least most of it, and you have invested that money that you borrowed in assets that are long-term. For example, most of this was used to, this should ring a bell for those who have studied the Euro crisis, most of this is going to be, most of these funds are being used to give people mortgages. So those mortgages are basically long-term assets. People are going to repay you, but they sign the contract saying over 25 years, and there's no way you can get your money back. If the people are not defaulting on their monthly payments, you cannot get that money back. So you have those assets, all those billions in mortgages, that are just giving you a small flow every month, because people only pay a tiny fraction of what they borrowed per month. And then you have this debt that was short term, and you now have to repay in full. And all you need is big mismatches like this for a bank to go bust. And this happens mainly to banks, but also, it could also happen, but to a much less extent, to some firms. So why does this matter? The two mismatches matter because they have been behind many, many crises, and it's still the case today. The Euro crisis and many crises all around the world are essentially going to be associated with these sorts of mismatches. The currency mismatch is sort of, there's nothing else they can do. You have to think about, why is it that these countries are not borrowing in the domestic currency? Why do you think? Why is it that the international investors are unwilling to allow them to issue debt in that domestic currency? Because they fear what? Try to think. Try to make money here. What's the risk? The risk is that the currency is going to lose value. So they lend you in the Thai baht, and then the Thai baht loses 30% value, and then they convert the money they're getting back into their money, euro or dollars, and it's a lot less. And so they're saying, I'm not willing to lend in your domestic currency because over and over again your domestic currency has lost value against my currency. So no, I'm basically reducing my exchange rate risk by only lending in my currency. So that's the key reason. So this is not going to go away. If you lend to a country that has repeatedly seen its currency lose value and go through currency crises, it's extremely unlikely you will be able to borrow in anything other than US dollars, euros, and so on. And the currency mismatch is also a characteristic of many of our financial markets. So these two mismatches are there to stay, and we just have to try to make sure that through regulation and so on, that we reduce the risks of these things. Or at least make sure that the countries that have these big mismatches are aware of the big risks that they face. Right, let's now apply this sort of stuff to the East Asian crisis. So I think the Krugman textbook is pretty good on this. So there's an entire chapter on emerging markets and several pages on the East Asian crisis. So, and you'll get quite a lot of details that I will not have time to cover. But the basic idea is, and I think all of you are aware of this, is there's a group of East Asian economies that have grown very, very rapidly since the 1960s. And these are the sort of so we're excluding Japan, and these are the main ones. So Indonesia is one of the most populous countries in the world, but all of these countries have fairly large populations, comparable to the populations of the bigger European countries. And so these countries have been growing very quickly, and the early 90s, with fewer barriers to capital flows, many investors in the developed countries thought that it was actually a good thing to invest in those economies. And so these countries started benefiting from very large capital account surpluses. So a lot more money going into the economy than going out. And so this sounds good news. One of the things that capital account surpluses allow a country to do is to invest a lot faster than it would if it were constrained to just use the domestic savings. And as long as you keep on channeling this extra money, so basically the investment from outsiders towards high return investment, there's no reason why this should be problematic. I would like to invest 40%. I can't really. My domestic savers only give me 30%, but if I get the extra 10% from international investors, I'm going to be able to make that 40%, which is great because I accumulate capital fast and therefore my economy is going to grow faster. So it all sounds well, and none of these countries are stupid in trying to do this. And this is, of course, one of the reasons why people believe that on the whole, free capital flows are a good thing. But there's a risk that a lot of that money is actually not going to fund investments that have very high returns. And there's, of course, a risk as well that a lot of that money is going to be used for consumption purposes. And the two key agents here are, of course, households. Now suddenly they have access to this capital from abroad, and they might say, why would I defer buying a new car, or why would I defer buying my first car, or whatever. And governments as well. Why would I defer improving this or that if I'm getting this extra money? And so, if a lot of the money that is coming in is being channeled towards current expenditure rather than investment, then this becomes problematic because eventually you'll need to repay this. Yeah? And so, you can have a period, and this could last for many, many years, where international investors are very, very happy to fund these, this difference between savings and investments. And so the current account becomes negative because people are investing substantially more than they save. The capital account becomes positive. And what happens if people again reassess the growth prospects of your country? And so they might say, well, actually, the rates of profits are not going to be as high as we expected, so lower returns on capital. And it could well be, this is the case for all of these economies, it could well be that they're seeing that these countries have a fixed exchange rate, but these economies are competing, especially in terms of exports, with other economies such as China, and their currencies, because they're pegged to the dollar, may be appreciating very substantially. And every time your currency is appreciating, as you know, you're losing competitiveness. So these sorts of reasons for the worries were all that you needed in order to have a total reverse of the massive capital account surpluses that these economies were generating. And here you have several financial fragilities. This is sort of just read this, so weak enforcement of contracts and cozy ties. So it's another way to say less, not that transparent. So, and then the double mismatch that I talked about at the beginning of this lecture. And once you have this, and if you add contagion, this sort of crisis could wreak havoc in an entire region. And as I told you, that's exactly what happened. And in many of these economies, this crisis is still remembered, even though it happened 15 years ago, more than 15 years ago. And it's called the IMF crisis in some economies. Always blame the foreign. I told you that last week. It's fantastic. And so even today, the media is always fantastic with blaming the foreign.